Good morning, and thank you everyone for joining today's session. We have a few notes before we get started. If you have questions, please submit them at any time through the question box and they will be answered at the end. We will continue to keep this webinar to the time allotted to respect your schedules. As a response to the COVID crisis, we have created this webinar series to bring you educational content in this remote working environment. As always, we are looking to continually enhance this programming, so we ask that you please complete the survey, which will come up after this webinar concludes. We value your input and try to cater these sessions to what you, our members, are interested in. We will be engaging with you throughout the presentation, after the presentation with that survey. Also, we will be sending out an email with a recording of the session, as well as a link to download the presentation after the conclusion of the webinar. We encourage you to visit our Financial Intelligence Library, where you can find articles, podcasts, and recordings of past webinars. And we have also dedicated a COVID-19 information page filled with up-to-date announcements from the FHLBNY with materials. We also invite you to join us next Thursday, June 25th, at the same time for the next webinar in our virtual event series, The Great Transition, LIBOR to SOFR, presented by Ray Shinazuka, Vice President and Director of Capital Markets Research, and Tom Citino, Vice President, Director of Member Relations. I'm now going to pass this over to Tom Citino. Tom?
Okay, thank you, Alyssa. Good morning, everyone. So we're really pleased to be presenting this session to you today on member credit, because I think it's really important, especially now during the midst of this financial crisis. It's really important for our members to understand, their own financial standing and how we arrive at a sense of your financial health, and also understanding the strengths of the membership from a shareholder perspective, because you own the home loan bank. We just run it for you. So you need to understand the strengths of the cooperative. So the financial health, just to kick it off, and Susan Isquith, Managing Director of Credit Review, and then also Fred Puro, Credit Review Officer, will get into the strengths of the membership. But on an overall basis, the strengths of the membership is in overall good shape right now. But the current crisis really illustrates how things can change rapidly, and that we are indeed navigating through uncharted waters together. That's the name of the session. So there are certain factors that can impact the financial standing of each member at the home loan bank, and it's important to understand those, because things that will impact the way you do business with the home loan bank, from pledging collateral, and also as a member embarks down a path of financial deterioration, there could be potential term changes. You may not be able to, depository institutions in good financial health are able to borrow from overnight out to 30 years. The term may shorten. And then really, when an entity is really experience financial deterioration, it could get low as 30 days and even overnight. So it's really important to understand what goes into our analysis of the membership. Lastly, I just want to end with, we're always going to be able to lend to members, even up to the last day of their existence. We work closely with the regulators, but we'll lend to a member as long as they have adequate collateral in place to support the borrowing, and then there's a willingness to purchase the requisite capital stock when executing the borrowing. And like I said before, terms could change, but we'll always be willing to offer you liquidity. So as Alyssa had mentioned earlier, please submit questions throughout the session, and they'll be addressed at the end of the presentation. So let me kick off the webinar. I wanted to introduce Susan Isquith, she's the VP Director of Credit Policy and Review. And then after Susan gives a presentation, Fred Puro, Credit Policy and Review Officer, will take over. So thank you both, Susan and Fred, for presenting today. And now let me turn it over to Susan.
Okay. Thank you very much, Tom. As Tom mentioned, I'm Susan Isquith. I'm the Director of Credit Policy and Review, or CPR, as we call ourselves. It's my pleasure to virtually speak to you about CPR and how the team monitors the financial health of our members. I'm joined by Fred Puro, who will also be presenting this morning. The rest of the CPR team consists of another 3 colleagues noted in the slide deck. We are all responsible for monitoring the financial condition of our members, as well as bank counterparties, to ensure the safety and soundness of our bank. Fred and I will be dividing our comments into three sections: the financial tools that we use to perform our risk reviews and financial analysis of our members, our opinion of the quality of the member of our membership, and the prospects and risk outlook of our membership in light of the changed economy. Our analytical focus in the credit group is on assessing members' changing risk profiles, changes as we believe is occurring now. Our overall goal is to keep the FHLBNY safe by managing the risk profiles of members. The bank has over 300 members, so we developed internal credit rating models to be used as a screen to determine which members require a deeper dive. Most of the slides in this presentation discuss detailed credit rating model components for bank members. CPR also developed credit rating models for credit unions and life and PNC members that consider their key risk parameters to determine the credit rating of each member type. The approach that we take to monitor banks that I will be discussing is the same for the other member types as well. If anyone in the audience would like more information about the other models, our contact information is listed at the back of the presentation. Feel free to give us a call. Fred, next slide. Okay. Our credit rating models are based on financial ratios that address the member's asset quality, capital adequacy, liquidity, and profitability. All the key factors that my team reviews when analyzing the credit quality of members. The credit ratings are calculated quarterly using recent regulatory financial data pulled from S&P Global Market Intelligence, previously known as SNL, for those of you who in the audience who use this software. As part of our overall risk assessment of a member, in addition to the financial ratios that I will discuss later, we also factor into the rating the impact of several other risk elements, such as the member's regulatory credit rating, commercial real estate or construction loan exposure in light of this pandemic, as well as the previous financial crisis, and a large concentration of broker deposits. And we also add for credit unions 2 factors that relate to vehicle loans and unsecured loan concentrations, which were the cause of failures during the last financial crisis. In essence, our internal ratings are a summary form of our risk opinions of members. We have a rating scale ranging from 1 to 10. Ratings from 1 to 5 are considered task credit. 6 is special mention, and 7 to 10 are watch list. Next, Fred. Next slide. This is okay. The model incorporates 11 key ratios that focus on earnings, liquidity, capital adequacy, and asset quality. This focus is similar to that of the regulators with their CAMEL assessment of regulatory ratings. The specific ratios used in the model are shown on slide 3. The final rating is heavily weighted towards capital adequacy and asset quality. We consider capital as king. A very well capitalized member can withstand losses due to changes in the economy or other unexpected external events. In fact, we are seeing now that the buildup of capital required due to the last financial crisis is serving the financial community well in the current crisis to cover increased provisions and expected future losses, which are reducing earnings due to the pandemic. But now back to the model. As you see, capital adequacy component consists of the Texas ratio and the leverage ratio. Prior to March 2020, this section also included the risk-based capital ratio and the Tier 1 capital ratio. They were just removed due to the regulatory changes in that community banks are no longer required to file risk-based capital or Tier 1 ratios should they meet certain criteria. So for consistency, we revised the model for all bank members. Asset quality is also heavily weighted as most bank failures are caused by losses from loans. We track non-performing loans as well as delinquent loans which become potential non-performing loans, and the charge-off in relation to the non-performing loans. The performance ratios that you see are straightforward indicators of the earnings and operations of members. And lastly, there is a liquidity ratios which provide an indication of how dependent a member may be on external funding rather than core deposits, as well as the level of short-term assets to cover liabilities. Next. In addition to these core ratios, slide number 4 shows that the model incorporates other potential risks and mitigants which may be added or subtracted from the final rating. Points are deducted if a member receives a composite score of 1 from their regulator within the previous 18 months. Since we don't see very many 1s anymore, the point reduction acknowledges the sound management and financial condition of the bank. We also deduct points if a member has a parent with an investment grade NRSO rating and can provide support should our member run into trouble. Points are added to the final rating to reflect the following risks: commercial real estate exposure and construction loans in light of the pandemic as well as in the previous financial crisis. And similar to the FDIC and OCC, we noted that banks with heavy CRE exposure and construction loans relative to risk-based capital represented a large percentage of failures in the last financial crisis. We assign points if the members' ratios exceed the regulatory guidance of 300% CRE to Tier 1 capital or 100% construction loans to Tier 1 capital. Again, prior to March, we used the risk-based capital, but since some banks are not providing the RBC, we switched the model to include Tier 1 capital. Banks with large concentration of broker deposits during the last crisis also failed more so than banks with core deposits, primarily due to the bad loans that they made with the deposits. So we've added them as a risk factor that we look at in analyzing our members. Next, Fred. Next. Okay. Slide 5 shows the specifics of how a rating is determined. There is a 1 to 10 rating range for each ratio. That factor is multiplied by the weighting you see in the table to derive a net score. If a member has any of the previously mentioned factors, we add or subtract the designated points to arrive at the final rating, which is also between 1 to 10. If the member does not have any of the additional factors, the net and final score are the same. In this example, the member's CRE to Tier 1 ratio exceeded 500%, which added 100 basis points, which was offset by 50 basis points for parental support. The Pass with Care label was added so the analysts are aware of which members have these concentrations, even if their credit scores are satisfactory. Next, Fred. So how do we use these ratings during our reviews? As you know, all borrowings must be collateralized. We have different collateral categories based on asset quality. The strongest members are assigned a listing collateral category. If a member's financial condition starts to weaken, we assign a listing in Seg 1 or a listing in Seg 2 collateral category, both of which require a little bit more work on the part of the member, but the mortgage files are maintained in the member's vault. A weak member is placed into the possession collateral category and must deliver all mortgages to the FHLBNY vault or our third-party custodian, depending upon the number of loans pledged. Next. We also use our credit ratings, as Tom mentioned, to determine if credit restrictions are warranted. As you know, the FHLBNY will always lend to its members as long as they pledge eligible collateral. But to ensure the safety and soundness of the co-op, we may reduce tenors of borrowing or require additional collateral haircuts on collateral pledged or collateralized accrued interest and prepayment fees as provided in the bank's credit and collateral escalation policy. We also use the rating to assess those members that are eligible to participate in the bank's mortgage partnership finance program and affordable housing program. Members with extremely weak scores in the 9 and 10 range are no longer eligible for these programs. And lastly, as a refresher for those of you who may not be aware, the bank's borrowing limit policy for members is set at 30% of total assets unless there are regulatory limits that are lower. Some insurance company members are domiciled in states with lower borrowing limits. In certain situations, a member may receive management approval to borrow up to 50% of total assets, meeting specific eligibility criteria, which include strong business justification for the increased limit and a very sound financial condition. A member must have sufficient eligible collateral and maintain certain collateral levels, and a member must be in compliance with collateral reporting requirements. Although this is a quick overview of our model and how CPR utilizes the credit rating model to analyze the credit quality of our members, I note that many hours are spent digging deep into the credit quality of our members to ensure that the Federal Home Loan Bank system's 37 years of incurring zero losses continues. I now turn the presentation to Fred, who will talk more about the sound financial condition of the membership and the outlook for the rest of 2020. Fred?
Well, thank you, Susan, and good morning, members. Let me start off by making a few comments about the quality of our membership. Now, in light of the softening economy because of this coronavirus pandemic, we in the credit group are now presented with the question, how creditworthy are our members? Well, given our knowledge of our members from our ongoing monitoring of their financial trends, we still believe that the banks, credit unions, and insurance company members are very creditworthy. However, it's only fair to say that at this point in time, we also expect that 2020 could be a very challenging year for the members. Now, overall, we believe that our membership strength is the strongest in years. And my comparison looks back over 40 years when bank risk profiles started to change because of deregulation. And for those that have been around, it goes back to the 1980 period. Our current favorable assessment of the strength of our membership is based on the following observations. Now, as most of you know, 2019 was a good year for banks and our membership in terms of the financial performance. The banks had a record year in terms of results, and our bank members and credit union members posted strong earnings. Profitability trends were favorable, helped by good loan growth with some moderation in the first quarter. Margin contraction was the key challenge for banks in 2019 and the first quarter, but good control over expenses reflected in sound efficiency ratios and helped support consistent profitability levels in terms of return on assets and return on equity. Now, while commercial loan growth was strong in April, especially for the larger banks, volume has been slowing down in May, and the loan volume going forward may not be sufficient to offset a narrower margin in the second half of this year. Asset quality, which is very important to our evaluation of member risk profiles, was also solid in 2019 and in the first quarter, with little change in some of the key loan quality indicators. And of course, capital. Capital remains a hallmark financial strength of the banks, which will be key to cushion any changes in asset quality for the rest of 2020. Now, on this slide 8, we show favorable financial trends of our bank and credit union members over the last 5 quarters. Now, these ratios are median data points for each period. And you can clearly see that member bank profitability was consistent in 2019 with a dip in the first quarter due to CECL-related loan loss provisions. The net interest margin contracted 19 basis points in the first quarter relative to the first quarter of 2019 and contracted 6 basis points from the fourth quarter of 2019. The bank members' asset quality indicators show non-performing loans at a very manageable level of under 1% of loans. And while we are watching non-performing loans, we clearly look at the loan loss level. And as you could see, loan losses continue to be well managed at modest levels. Now, while delinquent loans, well, we define those as loans that are 30 to 89 days past due, while they increased in the first quarter, the level is still deemed modest at 0.5% of loans. And bank member capital ratios remain strong with a median leverage ratio over 10%. And as we look on the slide, we also have information on our credit union members. And you will see that their financial metrics have also been favorable, whether you look at the profitability metrics, the asset quality, and the capital levels. I would also say that the financial strength of our members is also reflected in the low number and the low percentage of members classified as a watch list, again, those that are rated 7 and above on our scale, and special mention, those that are in the 6 category, as shown in slide number 9. In the first quarter, 14% of all members were classified as either a watch list or special mention, and this compares to 10% in 2019. But again, it's much lower than the 31% in July 2011 when the problems of the financial crisis peaked. So that was yesterday. Now let's discuss the prospects and the outlook for our members. Well, looking forward, we anticipate that 2020 will be a challenging year for our members, especially the smaller banks that are experiencing shrinking loan portfolios and narrower net interest margins. In fact, there are small community banks with efficiency ratios or cost-income ratios that approached 100% in 2019, which was a year before the pandemic hit and the economy changed. And so we're concerned with those institutions to a certain degree. We anticipate that a key driver behind 2020's financial performance will be the size of the loan loss provision. Now, if the economy does not recover quickly, asset quality can become more of an issue and requiring large increases in the loan loss provision in each of the remaining quarters of 2020. Now, many of the large banks have already alluded to the fact that the second quarter 2020 loan loss provision could be a repeat of the first quarter. These comments were in their first quarter press releases and the conference calls where they shared that information. So, for 2020, we are not expecting mergers to help banks grow or to help them expand their franchise, as members are trying to focus on preserving their good asset quality. In fact, there were only 12 announced deals in the first quarter of this year versus almost 80 in all of 2019's first quarter, and 18 in the fourth quarter of 2019. In fact, to see how banks will fare given the pandemic and the weaker economy, we just completed a special credit review in March and April to assess the strength of our members' capital to tolerate higher loan losses and to remain well capitalized according to regulatory requirements. The asset quality test stressed our bank members' balance sheet, assuming loan losses of 6%. The 6% loan loss ratio was used based upon the experience that banks had with problem loan levels and loan losses in the 1980s and the financial crisis of 2008. The results of the stress test showed that most of our bank members remained at least adequately capitalized on a pro forma basis. We also performed a slightly different asset quality test on our large bank counterparties, and this was based on their exposures to industries that are going through some difficult times. These so-called stressed industries included energy, leisure, and within leisure, as there's been a lot of information and publicity on the problems with hotels and restaurants, it also included the retail sector and transportation. And within transportation, there was a focus on the auto industry and airlines. So what we did is we identified the bank's exposures to these industries and subtracted the exposures from the bank's capital and reserves. And then with that net figure, we recalculated the pro forma regulatory capital ratios. The results from this test showed that capital was sufficient to support the banks. We also had a third stress test, and we show this on slide 11. And this was a special credit review on our credit union members with a focus on their vehicle loan exposures. Now, vehicle loans have been growing substantially with some of our credit union members to the point where the concentration level has exceeded 25% of all loans. Now, in addition, vehicle delinquencies continue to rise, and currently they're approaching the peak levels that were reached in 2011. Now, for the credit unions, the first stress test assumed vehicle loan losses of 10% of the vehicle loan portfolio because of the current almost 5% delinquency level. The second test on the credit unions assumed total loan losses of 3% of the total loan portfolio because of the concerns with credit unions' exposure to commercial loans and to mortgages. Now, we also factored in into our test the 1% loan loss experience that the credit unions incurred from the last financial crisis. The results of both stress tests showed that a large majority of our credit union members remained at least adequately capitalized on a pro forma basis. Now, let me make a few comments on our insurance company members. Approximately 10% of our 330 members are identified as insurance firms, which include life insurers, property and casualty firms, and health insurance companies. In order to assess the changing risk profiles of insurers, we focus our analysis on a company's statutory financial statements, and then specifically on the various income trends and changes in key balance sheet line items. Now, from our analytical work with insurers, we believe that the key to an insurer's strength is the level and the trends in capital and in liquidity. In our analysis, we are comforted today by the favorable levels of capital which have remained well above regulatory minimums for several years. In fact, slide 12 shows the capital trends for our life insurance and P&C members, which have been consistent. The insurance industry has also performed well over the last several years, as you will see on slide 13. Net underwriting gains, which we view as core operating revenues, have been favorable, with some losses at the P&C insurers in 2016 and 2017 due to Hurricanes Harvey, Irma, and Maria. So looking forward, the outlook for our insurance members is one of caution in light of this pandemic and the changed economy. We, however, are comforted by the strong capital levels, which we consider to be an important risk mitigant. So, in summary, while 2020 will clearly be a challenging year for all of our members, we remain confident that our membership will navigate this current changing economy successfully due to their preparation. And that is, they entered 2020 with solid financials, especially capital and asset quality. Their risk management skills have been refined over the last several years and are far better than what was in place in 2009. The regulators are also confident in the industry, especially with a low number of problem institutions and few new enforcement actions issued. And, which gives us a good glimpse going forward, we are comforted that the current underwriting standards have become more conservative. Thank you. Well, that concludes our formal comments. I will transfer it over to Tom to see if there are some questions.
Sure, Fred. Thanks a lot, both Susan and Fred. Appreciate all that information. Before we turn it over to questions, Alyssa has a few questions, but I had a couple of questions myself. I know the crisis, the current crisis, the 2009 crisis, but coming out of the last financial crisis, there were sweeping regulatory changes that were imposed to strengthen the banking industry, some of which are still being implemented. So higher capital ratios, liquidity standards, new allowance for loan loss methodology changes, risk management, stress testing, et cetera. Fred or Susan, do you have any opinion, or do you think that there'll be any sweeping regulatory changes stemming from this current crisis? Or do you believe the lessons learned and the items that were implemented from the prior crisis has been sufficient to maintain a strong banking industry that we currently have?
Let me give you an opinion on that. There have been a lot of questions about Dodd-Frank and the regulation coming out of the financial crisis, and sort of like a pendulum. You know, was it so far in the 2000 prior to 2008 to 2007? Was the pendulum so far to the left? Some could say yes, some could say no, but I think the consensus is that it was so far to the left. Dodd-Frank recoiled and it pushed it to the right. Now, depending upon your perspective, we are credit people, and obviously our focus is to keep the Federal Home Loan Bank of New York safe and sound so we can do our job in helping banks, our members, banks, credit unions, insurance companies, right? So from that perspective, the more, the better, I guess, to a certain degree of regulation. In fact, now that I look back, and to be very fair, I have a perspective. I saw the banking industry prior to 2008 and 2007, what was going on, and I see it today. And I would applaud the regulation of today because it allows many people that are looking at banks or financial institutions from a credit perspective to feel comfortable. And basically, it supports a lot of our comments today about why we feel comfortable. So I think they didn't overdo it. I think it was strong and prudent, and that's the key. The operative word is prudent. Now,
Okay.
obviously, we're in a difficult time, and we think that right now some of it is being rolled back a little bit, and rightfully so, because the regulation was, they treated all banks the same, and the risk was more of the larger banks, not the community banks. So the community banks are giving a little bit more leeway, and we think that is appropriate.
Okay, Fred, just have one more question. The situation right now in this very low rate environment, as you had mentioned earlier, members are being stressed from a net interest margin perspective. And at the recent FOMC meeting, they were talking about being in this environment for another 3 or so years. And Brian had mentioned that. Brian Jones, our economist, had mentioned that last week during the webinar. What do you think that's going to have? What kind of impact will that have on our membership? Or will we see do you believe we'll see, and you had mentioned earlier that M&A is kind of quieted down for this year, but in the coming years, do you think M&A is going to play a big factor on the composition of our membership from a depository institution standpoint? And I know our growth sectors for the membership are insurance companies and CDFIs, and also credit unions to a degree. But what do you think the membership is going to look like if we're in this prolonged environment for a few more years?
There is the expectation that rates will be low for a period of time, okay? And I guess it goes, and it basically is parallel with the economy being sluggish. Now, I guess nobody has that crystal ball, whether it's going to be a V, a U, hopefully not an L-shaped turn, right? But I think what has happened, one thing that we noticed during 19 and part of 18 was that what was driving bank earnings, yes, clearly margin, but again, margin wasn't really the key driver. It was loan volume. Banks were loan volume in the real estate, and later on in the commercial area was robust. And the other part, which is different than a lot of other, one thing that's unique about our banking system is that the percentage of non-interest income, fee income, plays in total profitability. Now, I say this as a prologue because those banks that do not have the product suite that would afford the non-interest income or a substantial amount of income is going to be in a little vulnerable position because net interest income, the loan volume might be sluggish going forward, as I mentioned, margin contraction. And so before we talk about asset quality and loan loss provision, we need to talk about the contribution of fee income. If that is not there, then you have a situation where profitability for the banking industry, for community banks, I would say for medium-sized community banks, would range somewhere in the 40 to 50 basis points return on assets. Now, we're hoping that the provision doesn't kick in because asset quality deterioration. If that's the case, that's a problem. Now, this is all, again, prologue to say that sometimes you need, in this environment, you need scale. And so while currently, I would say M&A transactions are on hold because of an introspective look at the balance sheet to preserve asset quality, there will be more consolidation. Now, you can see the stock market recovered a little bit, but go look at the bank stock index. That didn't recover proportionately. So until that recovers, then prospective buyers don't have the currency to deal with an acquisition. And clearly, cash acquisitions are not going to be used because of the depletion of capital. So yes, there will be consolidation. Yes, the membership, I think the universe will consolidate. But I think the area is those institutions, really small ones. If you look at the $100 million ones, the $150 million in size, where in 2019 loan portfolio was contracting, their efficiency ratios are at 100%. It's very difficult. Again, before loan loss provisions, it's very difficult to operate in that environment.
Okay. Fred, one last question we got from one of the members. So this will conclude the questions, but let me pose it to you now, Fred. So, and Susan, the question reads, in light of the changed economy, what financial trend will impact member asset quality the most?
I would say unequivocally, delinquencies. We are monitoring arrearages constantly. Now, the good news and the bad news. The good news is when you look at the core portfolios, they've been holding up. The only areas where we see a notch up in delinquencies would be credit cards, and they're basically the big banks are really playing in that arena. And as I mentioned before, vehicle loans and vehicle delinquencies. Okay, up until through this year, in the commercial loans, everything has been okay. But in May, for the obvious reason, retail in the commercial real estate area, well, prior to this year, commercial real estate and commercial industrial delinquencies were holding steady. But in May, retail commercial real estate and lodging commercial real estate delinquencies jumped significantly, almost 20% for lodging, as you anticipated, and retail close to 10%. So that's an area. So I would say going forward, it's going to be this commercial real estate. Now, there is a risk mitigant there. To the extent that loan to values are very conservative, and to the extent, as you know, in real estate, location, they're in prime buildings, we think the downside, it would be minimized in those areas. But overall, it's really delinquency trends that we're monitoring.
Okay. Well, thank you, Fred and Susan. Appreciate your time today. We're at our limit. We're at a end of time here. So that concludes our session for today. Just wanted to also plug next week's webinar, again, 11 o'clock on Thursday, June 25th. The title is The Great Transition. We're going to be speaking about the transition from LIBOR to SOFR. Ray Shinazuka, Managing Director of our Capital Markets Group, will be discussing that transition. He's going to provide a history, why we're transitioning to SOFR, home loan banks' role in the transition, how members can prepare, and how we can potentially assist with our SOFR-related products. We do have SOFR-related adjustable rate loan products, advanced products that members have been executing for the last since the end of 2018, actually. So it's been a while. If you ever wanted to learn more about that, please contact me. So again, that concludes our session. Thank you for attending. Please fill out the survey at the end, and we look forward to seeing you next week. Bye now.